Up now. All right, cool. Give me 1 second here. Got to flash the disclaimer. Blah, blah, blah. I might put this on YouTube Live or YouTube a little later briefly just to kind of show people what this is and how important of a strategy this is to learn. There we go. Okay. So effectively, we want to turn long-term investment positions into income strategies using the wheel trade. The idea is if you're looking years down the road and you want to own a company or own shares in a company for a duration, a long period of time, ideally you want to be kind of making a little bit of income on it on top of just, general buy and hold share appreciation. So the concept of the wheel trade is to always be selling options, whether leveraged against the long position or leveraged against cash that is ready to take on the position initially, or also even double the position size. So the idea there is to make sure that whenever you are long equity in the company that you want to own for the duration, and it can be an ETF as well. I'm going to use an ETF as an example. You want to have enough cash set aside to be able to take double the position size in order to make this income strategy work. In essence, if you are looking to hold half the size in the long run, the other side of that being cash is what you are willing to take on in the short term in order to generate income. So what you would do is either sell a put to enter the position, which could be in the money, at the money, or whatever you choose. And since we have intrinsic value in the money and extrinsic value out of the money, we can get either paid to wait for price to come to us, or we can get a slightly better than intrinsic price just selling a put in the money. This one expires this Friday. So this is probably not the best one to go and sell for an initial entry. Another rule is if you find yourself with double the position size in long equity, you want to be able to defeat your green-eyed monster or your FOMO demon, whichever you want to call it, and take advantage of the fact that you paid a lower cost basis for those extra shares, and that you should do whatever is necessary to try and make a profit from those shares, whether it is the profit from the premium from assignment or possibly the premium from assignment plus share appreciation from the strike price. Let me explain. Let's say I sold to open a $31 put here, and let's say it expires next week, and I received, let's go with a round figure, $1.50 for this position, or in premium for this option. So I'm agreeing to buy 100 shares per contract at $31 strike price for every one of those I sell. And this will have to do with your position sizing. If you let's make the math simple and just do 1 for 1. So in this case, you would be allocating the amount of cash necessary to buy 200 shares of this, but you'd be willing to sell this put option just slightly out of the money so that you can get paid to wait for the price to possibly approach your strike and assign you. If you are not assigned and that option expires worthless, or you buy it to close for less than you sold it for, that profit therefore counts as cash against your cost basis. So then you can go and sell another one until you are finally assigned, or if you'd like, you could even just acquire shares at market value, whatever that is, whenever you decide to enter it, and continue selling out of the money puts. And suddenly, you also have the option to sell covered calls. So With this strategy, you can generate income on both calls and puts at the same time. Sometimes price action will govern your decision in that position. So if price is consolidating at a fairly low edge of expected range in the equity, you might end up selling puts for quite a while before you are comfortable selling out of the money covered calls, because ideally you want to sell these as close to support or resistance as possible. So you want to sell puts as close to support as possible and sell calls as close to resistance as possible. So essentially, if I sold this to open and I got $1.50 for it, my cost basis is not $31, which is the strike, should I be assigned on these shares. My cost basis is $1.50 down. So $29.50 is my cost basis. If support price is currently, let's say 28 on this thing, and it dips down to 28, I still have, not 28, sorry. 29, I still have 50 cents of leadway in the premium received from this cash secured put. So within a bit of squish there, I'm okay with that position, and I have cash in reserve to sell another put even further out of the money and lower my cost basis even more, because as price approaches these strikes, all these options that are out of the money will go up intrinsically in value, or extrinsically in value, that is. On the call side, let's say price kind of went up to $33 a share here, where you could get about $1 appreciation, plus you get the dollar in premium on this. So if you were long shares and you sell this call while you still have that put open, they can't both expire in the money. So if you get assigned on the put, cool, you get more shares. The call probably expires worthless, and now you've doubled the amount of premium nearly that you've got in play. So at some point, it's ideal to own at least 100 shares long in this company, whatever it may be, so that you can generate both call and put income. That kind of compounds your cost basis lower and lower with much more speed in the market sense. So while price is playing around between support and resistance, you're getting paid on either side of it. So you're selling options on either side of price, and you don't have to care which one gets run over. So if you are assigned on a put and you have a covered call open, your cost basis goes down even further, because the call can't expire in the money at the same time a put expires in the money. You see what I'm saying there? So effectively, you've nearly doubled your premium and got paid to sit and wait for price to approach a price that you're comfortable owning that at. Over time, if you rinse and repeat this, and even if price is in a slightly bullish trend, you can adjust this position. You don't have to continuously sell the same strike put. So if price goes higher and higher, well, these two out of the money puts will go up with the price. So then suddenly you're selling slightly higher puts. You would think that selling puts that are above your previous cost basis is kind of suicidal, but in a trend, it's not. You're just willing to take possession of another 100 shares in that basis. So if price does dip down, in the meantime, you've got covered calls that are also appreciating. So when price dips down to your put, you sold those calls for a high premium. You can either A, let them expire worthless at the same time that the put would expire in the money or at the money and risk assignment, and you wouldn't mind. On the contrary, on the call side, if you sold a call to open and you are called away from your position because that covered call leverages against your 100 shares long per contract, you've got the premium that you sold the call for, as well as the premium you sold the put for in appreciation. So let's say you did get your cost basis down to about $29 or $29.50 or whatever we came up with. You would have an additional, about $2 worth of premium weighing against that cost basis. So your cost basis would be more like 28. So the difference is, if you sold this 33 strike and your cost basis is at 28, all that share appreciation is yours. So it doesn't matter if you get a sign on either side. It's not the end of the world. It's just sometimes you got to reset. I have had occasions myself where I get a sign on a call and then price either continues to run up or immediately declines afterwards, and I'll wait patiently. I don't have to be in that position if there's volatility. I can wait to find the edges of support and resistance and still keep a journal on my previous cost basis to keep running it down. As a matter of fact, I spent about a month out of TNA between October and November waiting for range to be in my favor. So essentially, I had already had a cost basis down by October for half the position size or more. My cost basis was, if I recall, is negative $1.36 or something like that between March and October. But that cost basis was on half a position size. So effectively, I owned half of my potential position size for free. If I didn't take any further positions, I have acquired a long position in that company for less than $0 per share. So I could come back anytime, flip another 100 shares in at whatever price is, add the two cost bases together, and then divide by 2, and then have my current cost basis. So yes, it would increase it all of a sudden, but overall, the performance is there. You've already achieved 100% of half the position size. So last week, I was finally able to crunch all the math on position size and cost basis. And in my current position, by the time we had talked about it, my fiscal year profit on that was overall, if I was to take both the cash and 100 shares long allocated, was 58%. Try doing that in the S&P. So pretty good returns, and all I had to do was patiently sell calls and puts. Not to mention, it can be fairly passively managed. When I was still working a full-time job, I was able to kind of do a little bit of technical analysis on a chart, find support and resistance, and effectively just set limit orders with my broker should those options approach those prices. So the important thing there is, if you're running this in a passive strategy, is make sure you're aware of 2 columns that you can add to your options chain in most brokerages. You want to know what the low and high is of the previous day. So let's say the market's closed and these aren't going to move. I want to know about what I can get for selling to open these options, okay? So if there's a difference between like 108 and 128 here, I think like 115 to 120 is reasonable for a limit order. I know it'll probably fill. So if I have to go to work the next day and I can't look at my my charts or my positions or anything really till like lunchtime or a bathroom break in some cases. Some people take a little bit of time in their bathroom break to look over things. It's just kind of human nature. So long story short, just through the process of limit orders over and over and over again, I was eventually able to generate enough income on this strategy to pretty much buy my freedom. I didn't really need to work full time anymore. And it can be done fairly passively. It does come with risk. You're definitely going to have to keep an eye on market conditions, and certainly these recent market conditions are quite volatile. So it's not without downside risk. There's definitely the potential for the market to continue plummeting and go for a massive correction, or not necessarily a meltdown, but it can be bearish for a while. An ideal entry for this position is kind of not necessarily bottom fishing, but finding equities or ETFs that are kind of cruising along support lines or close to it. I would also say ideally they should be in at least a slight bullish trend. But over time, it won't really matter if you've owned that position or you've been running the wheel on that position for enough time. Even a slightly bearish trend is still profitable. As I've proved with TNA here, my current cost basis is down to like $16 and some change. I don't think it's going to quite get there, but it could. In the meantime, yeah, I would give up a whole bunch of time that I've spent shifting into and out of call and put positions in this. But that's okay because my cost basis will continue to go down with it. So I'm very likely to be ahead of any bearish curve after a fiscal year in this position. And that should be your long-term outlook. So if you're willing to own something for that long and you're willing to deal with potential downside risk, this is ideal. Because not everything continues to go down. It's not like NVIDIA is going to be delisted overnight or even approaching Chapter 11 anytime soon. So something like NVIDIA will probably be around for a long, long time. TNA here, it's a little risky because it's a leveraged ETF. The only reason I run with it is because it has fairly high premium for the amount of outlay, which is another kind of rule that I established for myself. If I can't get $1 or more in the second week, just a couple strikes out, I usually don't mess with things in this price range. But if you think about it, that's a pretty good percentage yield for a $30 assignment. And on the contrary, the call side, pretty good yield, especially if I double it against this cost basis. So it's $3,300 for 100 shares minus $100. Well, minus $200 if I sell the put too. So it's $3,100. Eventually, you make enough income on this so where even if things are bearish for a short term and you have seen some downside risk, you still have opportunity to continue on and continue generating income on it. If in 2 fiscal years in this position I am at a negative 100% cost basis, I own both my allocated cash and the net long position for free. So years down the road, as I'm still generating income on this, it's just going to continue to pay me to rent this thing out. That's another key word, and a lot of property owners who own rental properties will understand this. Think of your equity as if it is a prestigious rental in a hot market. Everybody wants a piece of it, so you can feel free to charge a premium for people to rent that from you.
Let me jump in for just a sec with,
Sure.
If I may.
In fact, I was hoping you would.
Yeah, Jeremy's approach, let me just point out, because we've got some new folks here.
Yes.
And some of your heads may be going, why? What? Following Jeremy's stream, I'm going to do a follow-up stream for beginners.
Yes.
On a basic level. I'm not saying that Jeremy's not doing a beginner's video, but he is doing a more complicated strategy in a lot of cases. Nothing wrong with that at all. But I'm going to do purely the most basic of wheel trade overviews and how I choose stocks and things like that. So as soon as Jeremy's stream stops, he'll archive it. I'll start a stream and try and remember to record it, and I'll post it as well. Not competing with Jeremy, understand? I'm not competing with him. I am supplementing by looking at it from a different perspective of just doing the most basic of basic wheel strategies. So it's not a competition because we're both doing the wheel strategy. We just have different approaches to how we do it. That's all. Anyway, that's all I wanted to say for the moment.
Absolutely. Oh, and that's something I tend to not necessarily overlook because I know everybody's got to start somewhere, but ideally you want to go into this with at least conceptual operating knowledge of how options work in the basic sense of it. A call option is by the person who sells to open it, an agreement being sold to whoever buys that contract, that the seller of that contract will be willing to part with 100 shares per contract at the specified strike price. And for that contract, there is a premium charged. So this is what premium is. On the put side, the options contract is simply the issuer agreeing to sell 100 shares per contract at the given strike price. Wait, that's wrong. The issuer or person writing the contract is agreeing to buy 100 shares per contract at the given strike price, and there's a premium for that as well. So the buyer of these contracts is on the speculative side of things, and the seller of these contracts are on the risk side of things. So you can write contracts, and you can also buy those contracts to close them. You can also allow them to be exercised so that that contract actually runs through its course of what it's intended to do. And either way, the person on the risk side is selling time. These contracts depreciate over time, and they also will have fluctuations in their price via delta shift. So if we look at delta, each of these contracts has a specific delta, and what that means is if price gets closer to the strike, it will increase by that much. Each day, this number gets lower and lower. And this number on theta, the time decay, gets higher and higher. So the fundamentals of the option is just simply this. With time, every day, this contract will go down in value by 2.7 cents per share, which is $2.70 per day per contract. If you look at the delta, if price runs towards this thing, the price will increase by 25.89 cents per dollar move. That's what these two numbers mean. So in this case, if you are selling to open options, this number also becomes a probability. So typically, you've probably heard people talk about the magic 0.3 delta, which is it has a pretty good chance of expiring in the money. Any higher delta,
23% delta has a high chance of expiring in the money?
anything 0.3 and higher.
Okay. Just clarifying that you were saying that right.
Yep. So that being said, since this is like a, currently a $5.85 asset here, this is MSTU, another ETF I like to trade. Each dollar that this thing moves, it's going to be incremental. It's a pretty slow moving right now. Later on, it'll be volatile again, but every dollar move this thing makes, this contract's going to go up in value by this, less this per day. So if I'm willing to own this at $5, I get a 40-cent premium right now, and it does nothing, it expires worthless. I keep this. The instant I sell to open this, this is deposited right in my brokerage account. This is mine. I can't lose this. I risk this strike to zero. So yes, there is downside risk. So if I sell this to open and price goes to zero, guess what? I own it at $4.60 because it's going to be strike price less the premium received. So share price depreciation from 460 to zero is what I'm on the hook for. That's my risk. If I simultaneously take a position in this and go and sell the 650 call here, that cuts that risk in half. Well, it cuts the adds to the premium, so it cuts the risk down significantly. But there's still downside risk until you achieve a zero cost. So over time, if I continue to sell these and they continue to expire, I just keep stacking up premium until I take a position at the strike price that I agree to buy it on. So the simplistic approach is to realize that options are really just contracts. They just agree at a specific price, and the agreed purchaser of that contract agrees to pay premium to the issuer of that contract for the privilege. So it's kind of a cool thing. You can be essentially renting out your position because you are willing to take the risk in the position. Hopefully that makes sense to most people. With this one, my cost basis currently, after starting a position on the 28th of February, is $3.25. Quite a ways below the share price. Plus, I still have a 450 strike put open. I think it expires this Friday, if I'm not mistaken. Where's the end of the chain? This thing's got a ton of range, so it's got a lot of options in the chain. So currently that 450 strike is worth 10 cents. I sold it for 45. So I've got 35 cents of profit on this thing, and I'm nowhere near taking assignment on this thing. I sold this contract when price was about I want to say 475 or 480, somewhere in that neighborhood. I'll have to look at my journal, which I can right now, actually. MSTU, here we go. There it is. On the 12th, I sold an April 4th expiration. That's a little further out. But it's a 350 put. I rolled it. Okay. Had myself confused there. So 350 put. Sold this for 45 to open. So I've got 25 cents profit on this thing. I'm still nowhere near assignment. I could buy it to close right now and net that and then roll it anywhere I want. So I have the option to purchase to close those contracts at a discount from what I sold them to open for at any time. And if you're doing your technical analysis and you see that price could potentially enter that realm and maybe even go below that support level, inquisitively, sorry, my words are minced today. Equivocally, you could get ahead of that by buying to close this contract, waiting till price finds support, and then selling either another one further out or reselling the original contract for even more premium. I've been known to do that in a day on this one. It has some pretty wild, $1.50 and $2 wide swings sometimes. MSTU is quite volatile. But in short order, because it's such a small outlay of cash, it won't take long to own this one for free and eventually own twice the position size for free. Just nickel and diming it with these little contracts that are out of the money. I think I might sell a covered call on this later today. Ideally, I want to sell the $8 strike because that's where resistance is on this one. So I might either go for this April 4th contract here. Should price approach $6, this would probably be closer to 45 cents or so right here. That would be ideal. So knowing about what the move is, so it's 20 cents, every dollar, you can calculate this, every dollar that this moves towards the $8 strike is going to be 25 cents, but that delta gets higher and higher as you get closer to the money. So delta is exponential. So if it makes roughly a 20 or 25 cent move, I could probably see it closer to a 0.3 delta, which is more likely to expire in the money, but I get more premium for it. And that's where price resistance is. So it's likely that price will pull back from there eventually and test a support level again. And then I just flip the table. The wheel goes around. I go sell a put. So a 50-cent move on this one would take it from 25 cents to 40 cents. So I could sell potentially that $4 strike if price comes down. So it can be a process of staying fairly nimble in this, if you're very keen on price action, you can actively trade this very, very well. But also, if it's something less volatile, you can use this same strategy to trade it fairly passively. So you can, as I was saying before, the night before you go to work, set those limit orders up in your broker and just go to work. Just being aware of what the high-low is will give you an idea of what should be about a mean price for that option. And depending on where support and resistance is, you'll probably get it filled. So like if I was to try and sell this 450 strike, for instance, with a limit order overnight, not saying I would passively trade MSTU. That would be not the greatest idea. You want to be active on something this volatile, but let's say a mean difference between these two is about 40 cents. I could probably set a limit order at 40 cents. So what if I leave 5 cents on the table and get a sign on, or get that contract open relatively easy the next day? And on the contrary, if I was already long 100 shares, I could go and probably look at the high-low here. Reasonably, I could probably sell this at about 44 or 45 cents or so the next day with a limit order. So it can be done passively on something volatile, but ideally you wouldn't. You'd rather do something a little less aggressive as far as volatility goes if you're going to do it in a fairly passive manner. What I do recommend, though, is on paper, trade something like this so that you can get used to the process. And then I'm sure Marziti, when he goes on the broadcast, he's going to also tell you a different way to track things with a profit margin rather than a cost basis approach, which is fine. I use a cost basis approach for two reasons. One, I want to always know where my break even is, should I have to bail out on a position, especially a volatile one. Or I could be using that as a potential point where I would adapt the strategy to something protective instead of something that is selling speculation. So in that case, I would probably turn something like that into what's called a collar strategy, but that's a whole nother club. So I can get to that. I can also work with people on that. If you ever have a question about how to operate a collar strategy, I'm all ears and I am happy to help with that. Sometimes if you end up in something a little bit out of hand and you're starting to approach your break-even price, it might be the thing to do. So it probably won't be. In fact, I'm not even considering doing one on TNA anymore as prices starting to bounce. But I'm keeping an eye out for, if things get worse, I can use that strategy. So for the passive, try and for passive with some experience in options trading, you can also run this on paper as well and just set limit orders on paper. Practice the strategy first. If you've got any experience selling to open options like covered calls, you can try this if you prefer to try it with real cash, but I would still recommend practicing the process, at least on paper, for probably a few months before you go and pull the trigger on something like that, just so you can understand how these things kind of work. The only caveat with doing it on paper for just a couple months is you have no idea what market conditions are going to be like further out. But what you will know is how fast you can reduce cost basis and probably stay with market conditions more or less. So plenty of things to think about with this, and I'll constantly be repeating a lot of the information on strategy. But I'm also going to be taking on the role of, we want to think together as a community and get together and find opportunity in the market for this strategy. So we can talk a lot about potential positions or trade plans, and we can talk a lot about what's got the best yield to risk. We can talk about what's got the best yield to outlay. Those are two different things, believe it or not. And we can come up with some pretty solid trade plans together. And also, we can learn the process. If we're brand new at this, we can definitely learn it on paper. And eventually, you'll all be pretty savvy at this income strategy. Whether you choose to use it or not, that's totally up to you. But in the long run, if you have this knowledge under your hat that you can utilize to deploy in the market for your benefit, all the better. This is just one of many tools that I use to continue to generate income in my portfolio, and eventually my portfolio grows. All right, I can take some questions if you have any questions. I've got till about 2 o'clock here, so. Any Q&A? All right. As always, feel free to ask these questions. I understand if you're not if you're a little bit shy and don't want to put questions in front of somebody that you feel might be dumb. Please know that in this community there are no dumb questions, and nobody will ever razz you for them. If they do, we are very quick to dismiss those people, or even say, hey man, this is a community where we all thrive together. We don't tear each other down, we build each other up. So that being said, feel free to ask any questions, public or private. You can DM me, or we can put them in the chat, preferably in a chat, because for every one person who has a question, there's probably at least another person who might be too shy to ask. So that will benefit more than one person when you ask questions. All right. I can certainly hang around for a few more minutes. Let me get into a couple other little things here. Let me get the price action part of this up and running. Give me 1 second. I gotta drag this module back to my dock, otherwise it disappears. Okay, charting. Let me go to MSTU here. We'll start with that. This is one that I highly recommend running on paper to get used to, because you're going to learn a lot in a very short time. Notice how this thing is in a mirror image of general market structure. We got an initial trend from IPO. We've got parabolic ripping hype going into this thing, and this is following MSTR. And then we have capitalization, and then we have capitulation, and then we eventually have the bottom where things crawl along and accumulate for a while. This is textbook market structure right on a chart, and it's a very short-lived chart. This hasn't been around forever. MSTR has, but this ETF hasn't. So we're right in a support area. We're within a decent range. We've got a pattern that can either be a reversal or a continuation. That's a diamond. And we know where the resistance is. We know where support is. So if we're looking to sell 350s until we can accumulate enough premium to lower our cost basis entering long shares here, we can do so. You can sell those 350s 2 to 3 weeks to expiration and roll them every week. I mean, you're going to generate about, 35, 40 cents of premium each time, but those add up, especially in a stock that's trading at $6 or $7 or whatever it is. Yeah, about $6. So you could just sell puts all the live long day while market structure is finding support and crawling along sideways without ever taking a position if you choose. So it's going to be completely on you how you want to do this. If you wanted to do something like this with cash and you continue to sell 350 puts, your outlay is only ever going to be that 350 strike minus the premium you receive for it. So if you receive, 40 cents for it, your cost base is going to be 310. So if you're ever assigned on that, you're already ahead. 2, you don't have to have much outlay. You have to outlay $350 less the premium you receive. So you have to outlay $310 to sell a 350 put, and you can do it over and over and over again. You can roll them in and out. You can sell them one day and buy them to close the same day if you want, twice, 3 times. I've been there, done that. You can go, if you're in an account that is under PDT rules, you can go and sell to open these contracts one day, buy them to close the next day, and then on that same next day, you can sell them to open again without committing a day trade. So you can literally walk along while price is going sideways, going in and out of these things. And if you're using Robinhood, even a nickel matters. Say you sell to open at 40 cents, buy to close at 35, it just continues sideways, and you can keep doing that. The next day, you sell to open again at 40, buy it to close at 35. The next day, and rinse and repeat over and over and over again until this thing starts to trend. So you can compound some pretty serious premium in a short amount of time if you do it that way. In fact, you can even do it passively if price is going to stay sideways. You can set these as limit orders every day. You can say, okay, my option filled. I got 40 cents premium. I'm comfortable taking a nickel every time. I got a Robinhood account. They charge me 3 cents a side. That's 6 cents round trip. No problem. 94 cents profit every time. Well, per dollar. You're running in and out of that position over and over again with passive position management. So you literally just look at it when it fills, or you can look at it at the end of the day, the work day. Say, oh, cool, my contract filled. And then immediately set a limit order to buy it to close for the next day and walk away. And if it fills, cool. If it doesn't, well, you still got a pretty low cost basis. Let it ride. So it's a concept that I've taught to many people, both in person and over the internet in some way, shape, or form. And most people who catch on have a pretty easy time with it, even if they've never sold or bought an option in their life. It just takes a little bit of time, and I don't mind repeating information. If you've got to ask me the same question 50 times, I'm not going to care. Bring it. I enjoy explaining this. So don't feel bad about overwhelming me. Don't feel shy about asking questions. And of course, feel free to gather knowledge while you're here, because this is something that can really make the difference in the long-term portfolio type. So hopefully I can help people develop this strategy to something that works for them. Just a quick story to tell. A couple of my local neighborhood folks and I got together to form an investment club, and I explained this strategy to some people who were typically the buy and hold investor types. They spent hours and hours and hours doing, investigations into fundamentals of companies and this and that's all fine. But then I told them, hey, how would you like to get paid to wait for that company to hit the bottom and bounce? And this at the time was during the COVID shutdown, so things were pretty low. And a lot of the wheel trade strategies were focused on simple real estate investment trust equities, which a lot of these people were wanting to buy anyways as a long-term investor. So over time, I taught this strategy to many people in that respect, and a couple of the bright spots were, one was I taught a local civics teacher how to run this strategy. Now, she was a buy and hold investor, but she was doing it with her daughter's college fund. Kind of risky, but she didn't invest before COVID. She invested during the lockdown. Very smart. Market was on the bottom. There was blood in the water and everybody was panicking. She saw opportunity. That's one. I taught her this strategy, and she turned community college money into Ivy League college money within 2 years. And I didn't really have to hold her hand. I just answered questions, and she chose her own things to run the strategy on, outside of anything I would recommend. So it can be learned by people who are completely unaware of options. It just takes a little bit of dedication to do. That's just one story. There's a couple others I've talked to recently who have done extremely well with this at the same level, just turning their long-term investments into something that's much more than what they would have gotten for just share appreciation. All right, well, it's about 12 minutes till, and I've got a fairly important meeting to get to, so if there's no other questions, I'm going to probably wrap it right about there. Or if I know Marziti probably has a comment or two.
Nope, I'm good.
Dang, that's rare. I'm just busting your chops.
Sorry.
It's all fair play and turnaround, right? But definitely practice this. Go look at the options chain on MSTU. And for now, if you just want to learn the process, if you're completely brand new to options, practice it on paper first. Pull up that chain and figure out what you want to do with this thing, what strike you want to sell, and just keep tracking it. If it ends up in the money, it's weird. You don't always get early assignment when it's in the money, when it has some time left to expiration in the contract. But if you're just doing it on paper, you can assume that it would be assigned when it's like 30 or 40 cents in the money while it still has a couple weeks left. Pretty much. I've had most cases where I sell options on this thing where they end up getting assigned when the price dips that low. But it's rare because I also have a friend who is kind of copying my position on this, who hadn't been assigned on the same contracts. So it's kind of random. Someone has to pull the trigger and execute it, and then the broker has to choose who to execute it to. That happens. I don't know why I'm more popular with my broker than my friend, but that is what it is. Sometimes early assignment will happen, sometimes it won't, and you have to be willing to accept that. But in the long run, you're after the premium anyway, so you don't really care if you get assigned or not. It's not the end of the world. It's actually a good thing to be assigned. Until you start looking at the way these things are taxed, which can be a bit of a headache for some, but it's still reasonable to grow your portfolio. Some ETFs will have slightly different tax structures on assignment where others won't. Anyway, I think that's about it for today, and then I'm going to do this every Monday. If I try and set it up at a fixed time right now, it might be a little hectic to try and adjust it, but I'm tentatively going to shoot for 1 o'clock every Monday. And then throughout the week, while I'm live streaming on Tuesdays and Thursdays, you can also feel free while we're live streaming to ask any questions about the strategy you'd like. You can also at me in the main chat anytime with a question about it. Feel 1000% free to do anything you'd like with that. I am at your disposal. And if you're a bit shy, you can feel free to DM me too. I don't mind that at all. Ideally, questions get in front of the community, but that's okay if you're a little shy with it. It's not a big deal. All right, then, guys. I will see you tomorrow at the live stream at 9:15. Thanks again.